If you are struggling to convince your client to invest in mutual funds, or you are looking for a new innovative ways to convince your client to invest through mutual fund, then you should watch this video. In this video, I am going to tell you three very new concepts, new arguments, which will help and make your life easier to convince your client to invest through mutual funds. Hello everyone, I'm Shobhit. I'm a fin-based growth expert and founder of Fin-based Growth Club. We are an aspiring community to build a new age mutual fund distributors who are determined to change how India invests. So coming back to what things we need to talk and what not to talk to our clients so that we can convince them that mutual fund is the right vehicle to use to invest their money, to build their wealth, to meet their financial goals. First, what we need to understand. The first thing which we need to understand is the background. When I talk about background, I mean that we need to understand that where our clients has been investing or saving. And if you see the India's financial assets where people have been investing, it is very obvious that close to 50% of the money is going into fixed income assets. So bank fixed deposits where more than 140 lakh crore has been invested or saved. Then you have post offices scheme, you have insurance policies. So these are the major venues where people of India has been investing or saving. So our argument, our information, our reasoning for our clients to invest in mutual funds should be based upon where they have been putting money, because they will be able to correlate in an effective manner. So I want you guys to prepare well as what are the pros, cons against these kinds of investments where most of our clients are investing. So if you start comparing with say fixed deposits or post office scheme, it will make much more sense to them instead of talking multi-cap, mid-cap, large cap, CAGR and so on and so forth. So let's talk the first and most important thing. Why? Because people are choosing bank fixed deposit or post office scheme, and which is safety. So this is the paramount concern for we all Indians. We want to put our money in the safer avenues where we don't have to worry about our capital. If we are so much in line with the concept that even though we are not going to get good returns, but if we are able to get our money back, then it is a good place to be in. So what we need to put the argument to our client. The first thing which I think we should be putting across is we are going to advise them to invest through mutual funds because mutual fund is going to provide them a diversified portfolio. Instead of putting the bank fixed deposit in any one company or any one bank, here in mutual funds, we are going to put that money into for 30, 40, 50 companies. So that itself is a great diversification and reduction of the risk. The other thing which we can put to our argument to our client is that the risk is function of time. So if they have enough time, if they know for the purpose for which they are going to invest, then the mutual fund scheme is going to provide them the various kinds of product for across the time horizon where they want to put in. So mutual funds are going to provide you a better risk efficient return. First, they are going to provide you a diversified portfolio. Then they are going to provide you a multi-asset portfolio. Please remember, mutual fund is an investment vehicle. It is a vehicle through which investors can invest in multiple asset class. You can invest in equity, you can invest in gold, you can invest in real estate, you can invest in foreign markets. So there is a huge diversification angle which we need to talk about. We need to convince our client that mutual fund is not only equity investment. There is much more to that, and the more diversified the portfolio is, the better it is for the client in terms of safety. And even though if they want to invest in an asset class which is going to give them a better, higher return, then we need to convince them that if they are ready to put that money for the desired period of time, definitely their risk is going to be much, much lower. So this is the one thing which I want you guys to make them clear, that the risk which they assume in mutual fund can be diversified and can be reduced to a large extent. The other thing which I would like you guys to talk about is the inflation risk. You need to tell your client that even though they think that putting in bank fixed deposit or post office scheme is not going to have any capital risk for them, but this is definitely going to erode the value of the money which they have. So if they are going to put their money in bank fixed deposit, say for their kids' education, and that the goal is say after 10 years, what we need to make them understand is the kind of return the fixed deposit or post office schemes are going to generate is much, much lower than the cost of inflation for our educational goals. So even though their money is growing, but the purchasing power of that money is not growing. For the purpose for which they have done their fixed deposit, the money which they have put in their insurance schemes, the money which they have put in their post offices is not going to help them. Whenever they need money for their kids' higher education, besides the money which they have put in bank fixed deposit, they need to compulsorily put some money from their active income at that point of time. So the purpose for which they are doing these financial investments, considering that these are safer avenues, is no longer safer, because the purpose itself is not met. So what we need to tell them, that the consideration which they are keeping in, that these are safer avenues in a real sense are not safer. So this is the first argument regarding safety, and if we are able to correlate them with example, I think we will be able to convince them in an effective manner. The other thing which most of the time people put when they put their money in bank fixed deposit or post office scheme is because of convenience. They will find every bank, every nook and corner of post offices scheme, and they have seen those banks, those branches day in and day out. So say these are very comfortable. Whenever they want to do bank fixed deposits, they can do. Whenever they want to withdraw money, they can do. Same way, if we want to talk about mutual funds, what we need to tell them is this is the only investment vehicle where the buyer and seller is same. So if you want to buy mutual fund units, you need to go to mutual fund company. If you want to sell mutual fund units, you are again going to go to the mutual fund company only. You don't have to search for a buyer or a seller. Now let me contrast this with say real estate. If your client is buying a real estate property, he is going to search for a seller from whom he is going to buy the property. At the same time, he need to find a buyer when he wants to sell the property. But in mutual funds, that is not the case. Here here the investment can be bought and sold to the same entity, and that is a big relief. Other important thing is here the price discovery is very, very transparent. Now this means what? So, just contrast this with real estate. In real estate, what is happening? In real estate, the price negotiation will happen with buyer and seller. But here, the transparency will be there whenever you want to buy or sell the units of mutual fund scheme. It is well regulated. Every day the price will be there in front of you whenever you are going to take the decision to buy or sell the units. So this kind of convenience you are not going to find in multiple assets which are available in the market. So we need to put this argument in a strategic manner so that they are able to correlate with you in a better sense. And as I told you here, not only the multiple asset classes where they can invest in, they have a varied number of mutual fund companies currently available in India. Close to 44 mutual fund companies today are in India offering various kinds of themes and investment avenues or investment schemes. So you will have plenty of choice to choose from. You don't have to restrict to a particular company. And this, if we are able to convince them, I think we are going to be convincing our client in an effective manner. If we want to contrast this with, say, insurance where people have been investing, we can pitch upon the liquidity thing. If you are selling a mutual fund scheme, you are going to get a transparent pricing, and in T plus 3 days, you are going to get your money in your bank account. Whereas if you bought real estate or any other investment, if you bought gold, jewelries or gold and you are going to sell that, first the pricing is not transparent, price discovery is not transparent. If you contrast this with, say, insurance policy, in insurance policy you will have compulsory lock-ins of 5 years. But in mutual fund that is not the case. Most of the open-ended schemes you can buy and sell at any point of time. After 1 year there are hardly any charges. So these arguments, I think it will be very easy for our clients to understand. As I told you in the beginning, our job is to not complicate their life, but to simplify their life. So if we are able to target, if we are able to convince them as comparing them with wherever they have been comfortable investing in, I think our job will be much simpler. Now the third point which I would like you guys to consider is of tax efficiency, which I think most of us are not taking this point seriously, or we are ignoring this to put across to our client. Now please understand, if your client is doing bank fixed deposit, if your client is doing post offices, there is a TDS. Now if they are not giving TDS, then the tax payouts are very high. But here in mutual funds, the taxation is much lower for various asset classes. If you are putting in equity, if they are putting in debt, the taxation is at a very lower level compared to if they are investing in the same asset classes in other avenues. Other important thing which we need to highlight is, in mutual funds, there is a concept of tax deferral. Now, what we mean by deferral? It means that unless your client is going to withdraw money, he is not going to be paying any tax on the profit which he is going to make. Now, please understand this. If you contrast this with, say, bank fixed deposit, where irrespective of your client has done FD for 5 years, 10 years, 2 years, every year the tax outgo will be there. But in mutual funds, even if you are going to make 100% return in a year, and if you are not choosing to withdraw your profit or investment after a certain period of time, you are not going to pay any taxes. So if your client is going to put investment for 10 years, whatever growth it may give you, you are not liable to pay any tax. And that is the beauty which we need to highlight to our client. Instead of saying the same thing which all the market participants are telling, if you are able to give these kinds of insights to your client, I am pretty sure that he is going to give you the due respect which you command. And if you are looking for a new way to develop your mutual fund distribution business, if you want to be a mutual fund distributor with a new age perspective, then I would love you guys to join my 90 minutes free masterclass. In this masterclass, I am going to tell you how you can become a successful mutual fund distributor and touch upon 3 important concepts. I am going to leave the link for the masterclass in the description. I would love you guys to see in the live session. In case you like the content, in case it was useful to you, I would love you guys to subscribe to our channel, give a thumbs up so that we can grow and reach as many people as possible with the same mindset. Thank you for watching. I am going to meet you next time.